We'll give a few stragglers a moment to log in. But it is 10 o'clock, and we appreciate you joining us for the December monthly market update. We here at Clear Vista Financial want to give our perspectives on the markets, the economy, and different things. And today, as usual, one of our financial advisors here in the office, Jesse Hamilton,
hey everybody,
is on the program with me. I think today's message, Jesse, is kind of a message of there's some good things, some uncertain things, but generally a positive view towards the end of the year and going into 2024.
Yeah, that's right. We got quite a mixed bag today of different things going on, but we can go ahead and get started if you want.
Let's jump in here. I'm going to go ahead and jump onto the first slide. Our agenda today, we're going to look at the index performances for November. Now, index performances don't necessarily mean how your portfolio will have moved or not moved, but it just gives you an idea of the things that most investors are looking at. But we're gonna talk about the November indexes. We'll take a look back at that. We will also give a macroeconomic update. I know Jesse has a number of charts to look at and some trends that we're seeing and some positive things that we're seeing develop in the markets. And as always, we will wrap up with a discussion of how this impacts you and so forth. But remember, folks, if you would like to interact with us on today's program, you can send us a text at 254-282-0495. And you can also send us an email at info@Clear Vista Financial. As always, our clients always get a copy of this presentation around the 15th of the month. So if you want to go back and listen to it, be sure to take a listen to that whenever we send it out towards the 15th of the month.
Yeah, I'm going to go ahead and shut our camera off so the viewers have a little bit more real estate. But you can see us now, and I promise we're still here. First off, for anybody who's new, this is called a candle chart, and we show them every month on our updates. And Mark and I are looking at these charts every day. Each candle is a trading day. Red candles are down days where the price closed lower than the open, and the green candles are the opposite, where the price closed higher than the open. So starting with the S&P 500, after declining every month since July, the S&P 500 index had a strong rise during the month of November, 9.62%. We'll discuss in a few minutes why this might be happening and why investors suddenly jumped in and participated. It also gapped open on right in the middle of the chart there on 1114. You can kind of see a gap in the trend that's moving. That'll be an interesting point for our technical analysis moving forward, and a support line for us as we look at the future. The price will have a tendency to fill that gap at some point.
That's correct. I'm just going to put over here and kind of spotlight that gap there.
Right.
That's significant. We don't necessarily like to see gaps if we're looking for positions to buy, because generally, like Jesse said, prices will have a tendency to fill that gap before moving higher. And so what this could mean is that, there may be some profit taking here the first part of December. And we're seeing that, with the S&P 500 here, we're still, and we'll have a chart we'll look at in just a minute that shows us a little bit closer, but we failed to reach the previous resistance, which was the year-to-date high in July.
That's right. That was 45.37. That's what it reached in July, and we were not able to reach that this month.
Right. So that's important to remember, and we'll continue to look at that as a key point of resistance. Although some positive changes,
yes,
we came off one of the lows for the year in October, and rebounded really quickly. We always look at those rebounds with a bit of caution and a little bit of pessimism, because we're still in a bear market. We're in the bear market that started, in the case of the S&P 500, that started with the all-time high in January of 2022. and we still have not recovered to that yet. We just see the cycles going through this particular bear market. Let's talk about the NASDAQ, Jesse.
Sure. So next up is the same chart for the NASDAQ, which is a tech-heavy index. It was similar to the S&P 500 this month, showed a strong run-up for the first 3 weeks. It closed 10.63% to the upside, but it's facing a similar resistance from back in July and the same gap on November the 14th. You can also notice how this index began to move sideways in the second half of the month and is actually still moving sideways this week, Mark, as we get into December a little bit. But this is one of the first times this year where we've seen the tech index underperform compared to other large cap companies.
That's right, and this is important because the tech large caps led the way in 2023, and that's beginning to kind of wane a little bit. That's not saying that the market's reversing or anything, just means that the tech large caps will are really going in a position where they're not the drivers that's pushing up the index. You may remember from a letter we sent our clients in October, we're talking about bear market recoveries and things and how small caps lead the way. But we're still not seeing that type of performance, which Jesse's going to get to in just a moment, as soon as I click on the button to make the slide advance.
So here's the Russell 2000 index, which is the small cap index, the 2,000 small companies in the U.S. stock market. And this index was positive 9.2 during the month of November. But what's really interesting and what we've been studying very closely this month is waiting for it to break above its 200-day moving average.
Yeah.
And I've drawn a kind of a crude version of it there in that blue sweeping line. But this is the universal sign of strength for a stock or an index. And I've drawn approximately where that is.
I'm highlighting it right here.
Yeah, you'll notice the stems, which we call shadows on the candle, the wick of the candle, if you will. And you can see how many times it tried to break that and it couldn't do it. And I actually included the December 1st candle. Normally I wouldn't, it'd be the last day of November, but I wanted to show that on December 1st, it did break through that line. So I thought it was important.
Yeah, and what remains to be seen is if the price for the Russell 2000 index can stay above that. But that's a good signal. We like to see that.
Yeah,
because that's more indicative of a broader, healthier market.
right.
All right, and let's look at long-term treasuries, Jesse.
Sure. So here's our long-term treasury bond index, and rates relatively stayed the same or slightly increased during the month. The index increased during the month, actually 9.55% during November. We'll talk in a minute about why this may have happened and the implications for people that are holding bonds, but we'll also do the look back, of course, and see how this run up is compared to the overall drag and the index.
Now, the long-term treasuries, where the yield is falling, that's why the index is rising. Now, it may have gone up 9.5% in November, but we're still down more than double digits in long-term treasuries for the year.
Yes, and of course, the overall picture we'll show here in a moment will show the 50% drop that we've had over the last couple of years.
But first, a little bit of an interlude with disclosures that we always have to share with
some
people.
Elevator music here.
Yeah, we really need to have maybe a little Spanish Flea, that song from the 60s that's used on game shows. We'll show that and move on here in just a minute.
Yeah.
Jesse, here, let's look at this 2-year look back on the S&P 500, or 3 years really.
Yeah, it's actually 3-year. I decided to go all the way back on the S&P 500. You can see the high in January of 22, like Mark mentioned, and you can see the low in October of 22. That was a very dramatic and volatile year, but you can see how volatile we've been since then. And most importantly, for the month of November, you can see the rise that we had compared to the previous 3 months of falling. That goes back to the high in July. And it's very easy to see right here the resistance that I mentioned earlier. It's in a red line.
That's the red line that you drew on there, Jesse, for our viewers there. So it's important to remember that there still are levels of resistance and headwinds ahead for investors. Not anything to be concerned about. It just means, okay, we're going to watch this area to see if the upward trend continues and the market turns around, or we just retrace back down again.
That's right. So here's a 2.5-year really look back on the S&P 500. That's the same chart in red and green. And then the blue line here is the Russell 2000 small cap index. So we mentioned in our bear market letter that we're not seeing small caps outperform large companies. And notice in 2021 how the blue line was above the green red line.
And that's just indicative of how 2021 was. It was a broad-based growth in the market, but you saw that convergence of the S&P 500 and the small cap Russell 2000 small cap index. And that was a sign there that the stock market was beginning to weaken.
That's right. And you can see them kind of track side by side all through 2022. And then let's move all the way to March of this year. They started to diverge.
Yeah, we're starting to diverge again. That was really important. That was really significant because we felt like that at the end of 2021, we had a little bit of a rally coming out of October of 22, excuse me. And the first month of the year was strong for large caps. That was the Magnificent Seven stocks that were pushing the indexes up. But then you saw really that it wasn't a broad-based rally, that the small cap index was vastly underperforming. In fact, at one point this year in October,
just a few weeks ago.
Yeah, just barely 3 or 4 weeks ago, the small cap index was actually negative 7 or 8% for the year.
That's right. So really one of two things can happen here, Mark, right?
Yeah, go ahead.
Either the large caps start to underperform, or the small caps start to overperform large caps. And obviously we want that second one to happen.
Right.
But statistically and looking at historical data, one of those two things has to happen.
The two have to converge, and the small cap has to rise above the large cap indexes to see the breadth of the rally improve and really sustain a long-term drive upward again to new highs.
That's right. And I was thinking about this last night, Mark, and how smaller companies really need a healthier environment to survive. They need good borrowing credit. They need healthy economy,
strong economy,
and
good buyers,
and people with cash in their hands. The large companies are a little tougher when it comes to that, and that's why we want to see the small caps overperform.
Okay, all right. Let's look at the NASDAQ just a little bit.
Here's the same 2.5-year, 3-year look back on the NASDAQ. You can kind of see how far things have gone since the previous high in November of 2021. And the red line I've drawn shows the close at the end of November. That price goes back to really the beginning of 2021.
So that's a pretty significant area of resistance that we're looking at here. You've got the July highs again that we haven't broken above. You've also got the highs from the early spring, which was a rally within the bear market, early spring of 22. And of course, we are a long ways away from the all-time highs that we had back in 2021.
That's right.
So more work to do. Bear markets take time to undo themselves, but we're seeing some positive things take place.
So here's a really quick look at the S&P 500, but equal weight. So this is the same 500 companies in the S&P, but each company gets an equal vote. And it really shows a greater story of the market breadth that we're talking about and what's happening across all the domestic large cap companies.
Okay. So now this index is slightly positive for the year, slightly.
Yeah.
But explain a little bit about the equal weight, because maybe people haven't heard about what's an equal weighted index and how is that different than a cap weighted index like the S&P 500 index.
Right. Well, in a cap weighted index, the very large companies, and I won't name them by name, but we know all the tech companies that we use every day, If they move 1%, the index is going to move 1% because they hold all the power.
Well, and they're just so much larger. Their mass of market cap, and we're measuring that in the trillions of market cap, has such a heavy influence on the rest of the index. But think of it like the Congress. You got a House and you got a Senate. In the House of Representatives, the number of representatives that are there are determined by the state size. So in this case, the size of the market cap of the large company.
Texas has a lot more pull.
That's right. Texas has a lot more pull than, say, Montana in the House of Representatives. But in the Senate, every state gets 2 senators. All right. So they're all equal weighted. And so this is what that index says. Every person on, or every company on the S&P 500 has an equal impact on the whole index, and when it's equal weighted.
I've drawn a black box here. That's what we call a trading range.
Yeah.
We would love to see this index break out from that box.
But we're looking back here to the highs in 21 and the first couple of days of 2022, and we just been in this oscillating price range for the last year and a half, almost 2 years now.
Right.
And we call that a trading range, as Jesse mentioned. We'd love to see it first break above this red line. Secondly, we'd love for it to break out of this trading range. That would be a sign that prices are going to hopefully continue up.
That's right.
In the right direction. All right, let's go on here to the next slide.
So here's a chart that shows the percentage of stocks above their 200-day moving average. That 200-day moving average is generally seen as the universal sign of strength and bullishness. And the black line is the end of October. That shows about 24% of stocks were bullish.
That means that 76% of the stocks on the stock market were actually in a bearish trend. Okay, and that's important because that gives you another indicator of the breadth and health of the market.
So these are the mixed signals we're telling you about. This nice run up that we had in November, we closed around 48%.
Okay.
So half, and we would really like to see this above 60.
Yeah, and it's dropped off a little bit in the last couple of days in December, but we know that's going to happen when you have a rally like this. There's going to be some profit taking that's going on amongst the day traders and things.
Yes. So I don't know if any of our listeners right now are familiar with a Fibonacci retracement. It's kind of a stock market tool that we use sometimes, but here's the S&P 500, and a Fibonacci retracement is created by taking 2 extreme points, a peak and a trough, and dividing the vertical distance by the ratios of Mr. Fibonacci, which are 23.6, 38.2. You can see them all over nature, and it's a recurring pattern that we see.
Of course, he was a mathematician, right?
Yeah.
Italian mathematician.
Long time ago.
If you look up a picture of him, he's wearing kind of a funny hat for those types of things. But so we're seeing that retracement, and we've gotten almost all the way back up here, but we still have some room to go from our July highs. And of course, if we drew this further and further out back in time to that 2-year period, that we could retrace that number, and you see that we're not back to where we are and recovering in those things. So, so that's strong resistance up ahead, right? The support for us is right here in the 50%. Is that the green area here, Jesse, that I'm highlighting?
Yes.
Okay, so that's a level that we look at to see if the market begins to sell off a little bit. That would be an indication of support. We want to see that maintain and hold so that we can have a next leg higher. And that's great. So still some positive things here, but still some caution ahead.
Right.
And it's not the same as we were looking at in October of 22, right? No. This is a different market. It is still a bear market, but it's still a recovering bear market, if you will. And we like to see this, but we like to see the momentum continue onward, upward, so that we can say that, hey, the market is healthy again.
Yeah. So here's one last really technical thing we'll cover today.
Well, this looks like my EKG, Jesse.
This chart is the price earnings ratio for the S&P 500, and it's simply the ratio of a stock's price to its income, and the index is currently priced around 19.
Okay. So with bond yields falling, investors will be willing to pay more for growth here, which opens the door to maybe a 20 price to earnings ratio or even 21 price to earnings ratio.
Right.
But what this means is, in order for us to see that, we've got to see the S&P 500 go up to about 5,000. If we want to get a 20 price to earnings ratio, the S&P should be around the ballpark of 5,000 on that index. Okay?
That's right.
So that just means that, the underlying stocks on average are trading about 20 times as much as they earn.
Which sounds crazy, right?
And this is really still above the long-term averages of the S&P 500. But this is a strong indicator too. We see this continue to rise. That's a sign of strength.
That's right.
Okay. So Jason, let's jump into the macroeconomic look here. Reminder to folks, you can send us a text at 254-282-0495, and we'll either get to them here on the program today or we'll follow up with you within 24 hours. But let's take a minute here to take a look at the economy and talk about the environment and interest rate environment heading into December. This is going to help us gain a little bit of perspective here with the markets. So a Bloomberg article, and this is one of my pet peeves, talking about soft landing, and our Treasury Secretary, Janet Yellen, keeps talking about the economy is going to have a soft landing. What that implies, and I don't know if you know, Jesse, but I attended several lectures by Dr. Yellen, and when I was at George Mason working on my doctorate there and stuff. So I know a little bit about her. That was 20 years ago, and her tone towards the economy has completely changed. She's become more of a political person than she was an academic back then.
Economist.
Yeah, if you're an economist, and now she's just political. So what she's trying today is massage the data, saying that we are going to have a recession, but it's a soft recession, and that we shouldn't be too concerned about that. Now we look at that and say, okay, what's going on here? So there was a lot of bullish milestones that were notched in November's big market surge, right?
We saw so many people, retail, institutional, jump into the market, but why?
It's the fear of missing out, right?
Okay.
The fear of missing out, but it really should be a lesson for Wall Street in caution. So time and time again, when speculation breaks out that the Federal Reserve is poised to ease monetary policy, which is what spurred the market.
Yeah.
And we can, if you're curious, we can point to the actual day where Federal Reserve Chairman spoke, and the market interpreted it as, oh, they're going to cut rates tomorrow.
That's right.
In fact,
he's speaking next week, right?
He is. It's the Federal Reserve's meeting that they have in December on I think it's the 13th and the 14th, the 12th and 13th, excuse me. We'll be watching it with a box of popcorn and a soda, because we listen to every word that the chairman says. His speeches are carefully crafted to make sure that there's no misinterpretation of things. But the market, investors are pricing in about a 1.25% amount of cuts in the overnight Fed funds rates for next year. We don't see it.
That's a big speculation.
Because we know that the Federal Reserve is very sensitive to cutting rates too soon. They don't want to do that. It's very reminiscent of the 1970s and 80s, when at the time Federal Reserve Chairman Paul Volcker decided to cut rates only to have inflation take off again. And we have to begin the rate hikes all the more, and even with a greater vengeance.
Yep.
So really, stocks are jumping, bond yields fall, and a dash ensues among equity speculators. And, when you start getting into things that are shady and meme flyers and crypto and even profitless companies and things, that's kind of November in a nutshell. So volatility has really fallen to pre-pandemic lows. And there's a survey that Goldman Sachs does. It's a gauge of global risk appetite. It's really hit the highest level in 2 years. But we got to go back to even June and July, where we thought we were having that thing. We had investor enthusiasm. The Treasury, the Federal Reserve is going to cut rates.
We had 3 months of correction.
We did, and it was a pretty significant correction. It's more than 10%, and that was just a little bit of a parallel here that we have to be careful about. Could this time be different? Maybe.
Yeah.
Maybe. But we let the data in our business, we let the data tell the story to us as to how we will invest our clients' portfolios. But, even Jerome Powell, the chairman, pushed back last Friday on prospects of interest rate cuts. He clearly said, hey, it's too soon to say that. That's not how the market said it. It's like,
they'd hear different things from what he says.
It's like Jerry Seinfeld's Bizarro World, where he says one thing and the opposite happens or something. And at the same time, this risk on exuberance. Remember the rational exuberance from Greenspan in the 90s? It's really working against the current Federal Reserve Chairman Powell's goal of tightening financial conditions. And we're going to talk about tightening in a different way that we don't think a lot of economists are looking at. But, that tightening, that goal of tightening has really contributed to the demise of past rallies like the one that we had in the early summer.
Mm-hmm.
So, it's important for us to keep this in perspective. So you've seen this swing back and forth from the market's overbought, no, it's oversold, and back again. And we need to see that some things improve before we get too much further into that.
That's right. So Mark and I think that the Fed is maybe looking at the wrong metrics. So here is the money supply, the M2 money supply, which is signaling that things are already pretty tight.
Yeah.
The top chart here is the M2 over the last 50 years. And then the bottom chart is a zoomed in 1.5 year look, closed December 28th or November 28th of this year. We can see what's happening with people's money.
Yeah, and I think that the people need to know this is the amount of cash that's in the economy.
Yeah.
This is what's in our bank accounts and so forth. And we've seen that dwindling quite a bit, off 4.4% off the peak in July of last year. And bank loans are down, commercial loans are down. This is getting tight. And no one at the Federal Reserve press conference will ask this question. If a reporter would ask this question to Chairman Powell, we're going to get a lot of insight. And we don't know why anybody does. Maybe it's on the do not ask list like they do at the White House. You can't ask these things. But I want to look at this in a little bit different way. This is kind of overlaying the M2 money supply and the consumer price index, which is a measure of inflation.
It's amazing how closely they track.
Yeah, it is. The red line here is the money supply. And you can see from its peak in the post-pandemic years, where the federal government and the Treasury and the pumped trillions, and I say that with a T, trillion, over $11 trillion
they
of stimulus.
They created that mountaintop right there.
That's
right
exactly right. And that has to come down. And as that red line comes down, we see the supply and M2 money supply contract. And that means things are tighter for people. They're having to borrow more, use their credit cards. They don't have as much cash from the stimulus and so forth. So, and here's inflation falling too. Maybe inflation will drop sufficiently for the Fed to cut those interest rates next year. And the reason that they would cut them is to sidestep a recession or worse, deflation. We don't want deflation. So we're just kind of to watch and see if they're going to throw in the towel or anything. I think the interesting thing here, Jesse, is the current money supply levels are, and this, I wish this chart went back further because I think the year would go even further, but it's below 2015, 2016, 2017, 2019 levels.
So people have less money in their bank accounts.
There's less money in the economy today than there was really 8 years ago.
Yeah.
That's concerning. That's a tightening of monetary, that's the effect of that tightening of that policy. So we got to watch that. Let's just spend just a second talking about inflation. All right.
So this shows the level of inflation every year during the Biden administration. You can see the peak in June of last year, and it looks like it's declining. But the misleading thing about this chart is that people assume inflation is lower than June of last year. That's not the case. It's increasing at a slower pace.
That's right. And we need to be aware of this because the prices of goods and services is still going up.
Yeah. And
albeit at a slower rate than it was in June of 22.
Mm-hmm.
Okay. And that's the important thing to do. Next month, Jesse, we probably should do a chart that kind of shows the cost of goods and how much they've risen.
Okay.
to give people some perspective, because you look at this and this is what the White House shares: inflation is falling.
Yeah, they say that in the headlines.
It's the rate of change of inflation has falling. It's not that things are getting less expensive. Prices are still rising, and you look at that, it's like, great, the Federal Reserve, the White House, they're all doing a great job.
They told us our Thanksgiving was cheaper than ever before,
which is a complete joke. And of course the press pool at the White House goes, oh, great. And it's amazing, folks, that the level of assumption that our media will take to try to tell the right story. No one asks the tough questions of our leaders, and we need to be doing that. So let's take a look here. This is the yield curve at the end of November. Once again, it's still inverted. And that inversion started in March of 22. That means over the last 22 months, Jesse, we've had this inverted yield curve, because normally when we see the yield curve in a healthy market, the short-term rates are over on this side, and the graph looks like this, so that the higher rates are out of here at the 30-year Treasury type rate.
Right.
We've got the exact opposite. And usually when that happens, that's a precursor to a recession. Now, we may have already been going through a recession, but the federal government changed the way they measure it. It's actually a different definition in the Webster's dictionary now than it used to be. So we're manipulating the story to send the right message. But this is still a concerning sign. When will we see this around? Because when this reinverts to the right level, we typically see a lot of chaos in the stock market. I mean, I'm just going back historically through past periods. You see a lot of ups and downs and volatility in the stock market. And I think it's important to realize this is something that we should be paying attention to. The Federal Reserve is meeting next week, the December 13th and 14th. I suspect they'll keep interest rates the same. I think there'll be they'll talk about the pause, and they may hint at some potential cuts in 2024. Folks have to remember, the cuts that are to come are because the economy is weaker than it was before.
Right. It's contrary news. It's
right.
Good news, bad news here.
It's good for the stock market. It's not so good for the economy. So, and here's we've shown this before, but the red line on here, Jesse, is this is every Fed rate hike cycles over the last 60 years, okay, relative to each other. And the thing I'm just trying to show here with the red line, this is the most recent. It's the steepest of them all, meaning that they raise rates very quickly. This is Federal Reserve, and the interest rate tool is one of the few tools that the Federal Reserve has.
They don't have a great toolbox. They really just have a hammer.
No, that's right. I mean, they can put assets on their balance sheet to remove money out of the market, or they can add it to it. Right now, they're going through a quantitative tightening process where they're getting bonds off their balance sheet. I know this is kind of convoluted in terms of the topic, and it's a little bit techie, but that is causing problems with bonds. We've got the Federal Reserve that just last month they were trying to do an auction of treasuries, and they did not have enough people subscribe and buy long-term treasuries.
Who are our normal buyers?
The biggest buyers are the U.S. banks.
Okay.
And then number one is China and Japan. Those are the top two countries that are buying U.S. debt. They did not have an appetite for buying U.S. debt this last month. So the Treasury had to flip the switch for U.S. banks that are required to come in and buy some of these bonds to support that. It's an agreement that they have.
But they don't just swap it. They have to sweeten the deal.
That's right. In order to entice the banks to buy more, they had to raise the yield on those long-term treasuries. And the other thing to watch is that the Treasury is refinancing long-term U.S. debt that's coming due at much shorter parts on the cycle. I mean, I should go back here. This is a great way to see this. Oh, where am I? Right here. They're refinancing our long-term Treasury debt at short-term rates. Now, you may be thinking, oh my goodness, the rate at the end of November was 5.5 or close to 5.6%. The rate on a long-term Treasury is 4. All right. So they're refinancing at these high short-term rates in hopes that the yield on the long-term treasuries will go down over time.
It's really a speculation that
It's
the
a
rates will go
guess.
down.
It's a guess and it's a wing and a prayer that rates are going to go down over time. We don't know if they're going to go down because it has to do with a lot of market dynamics and also what the Federal Reserve does as well. So let me get back on track here. Didn't mean to digress, but I think it's important to know. Why don't you cover some of the manufacturing indexes?
Yeah, so we didn't get any GDP data this month.
Not yet, right.
But we get the manufacturing index, and it remained at 46.7 in November, and that's actually lagging the consensus, and really levels higher than 50 signal expansion, Mark.
And that's where you want to see that. But I can't remember how long it's been below 50, but it's been several months that the manufacturing index, this is the indication of how much U.S. manufacturers are producing. And when it's below 50, that means that production is declining and shrinking.
Yeah.
Which means they're not producing as much. We're not buying as much.
It was actually the 13th consecutive month.
Oh, there you
Mark.
go. Yeah, that's right.
That's right. This is the longest streak since the 2001 recession.
Yeah.
So really looking at the bigger picture, this is another lousy report, of course. During COVID, shelter in place orders and extra compensation from the government, this artificially boosted the goods level activity that we talked about.
So this is an indication of the economy is contracting.
Yes.
Now let's do something else, right?
Okay.
It's like, oh, that's bad news. But then let's look at services, which they consider the non-manufacturing index. It's basically services. It expanded.
It did,
which is a good thing.
And it's above 50.
Yes. And so this is a good thing. So you had this one not so good data point and then a good data point. They're all kind of muddying the picture for the Federal Reserve to determine what's going on in the economy. Is it heating up? Is it contracting? The labor report tomorrow that's going to come out is going to be very telling to see how much employers are adding jobs. We got the ADP report that came out yesterday that showed fewer jobs in November than they expected, and some drop-offs in the service sector and places like that with like hotel and leisure and things of that nature. So tomorrow will be real telling to see that, but it's just back and forth of good positive data point, some not so positive data point. But we generally are thinking here that with this conflicting economic data and rebounding market, trying to predict a positive future. What does it mean for you? Well, we don't have a crystal ball. I wish we had one.
That'd be nice.
Because people ask us all the time, what's going to happen next year in the market? It's like, I don't know.
The most common question we get during
I'd love to have one. I wonder how people would respond if I pulled one out and started looking into it for an answer. We don't know what's going to happen in the future, but we do know that these conditions have led to a recession every other time in history of the U.S. economy. And so let's have a quick discussion on our strategy moving forward, because we respond to the data that the market presents.
Right.
We don't try to predict. We're not in the prediction business. We're in the trend following business. And right now, the trend is up to flat, sideways or up. And it's yet to be determined if it's going to continue on up or we're going to have a little bit of a profit taking in the next couple of weeks, only to have a rebound later on. It remains to be seen. But our approach to managing money allows us to respond to those things and try to not predict, but try to follow the momentum and the trend in the market. Right. What we'd love to see is the momentum to turn up and we have a long-term rebound or expansion.
A broad-based expansion.
Because the last one we had lasted almost 13 years.
Yeah.
And we'd love to see that. Let's, Jesse, let's talk a little bit about this. This was sent out to our clients in October in a letter.
Yeah, you've seen this before in our presentations for the last 2 months, but I just think it's really important that we examine history and, a time to get back the columns here. Look at the time to get back column. We can see the 2002 tech situation that happened.
I had to live through that.
Yeah.
In fact, one of our I can't tell you who it is, but I was working for PricewaterhouseCoopers at the time, and one of our clients led the way. They were at the peak and they led the way down.
Yeah. if you bought an ETF or a mutual fund that tracked the S&P in March of 2000, you made it all the way to March of 2013, making nothing. So the value of that index did not move over 13 years. And some of these conditions are not identical, but similar to what we're seeing now. And we just want to look back at history and see how might that influence our decisions.
Yeah, and really, this is to say that, hey, bear markets take a time to work themselves out. It's not the time to hide.
No.
Because we see that too, that people get burned in the bear market and it's like, I can't take it anymore. And then they wait and wait and wait until the market reaches a new high.
Right.
And then they decide it's safe to invest. And that's really, we saw that back in 2021 and 2022, that a lot of money jumped in the market only for the market to collapse. And they're going through this endless cycle. So we encourage you to don't be sitting on the sidelines, even though there's a tremendous amount of investor cash parked in money market funds avoiding the market. We want to encourage you to talk to an advisor. We prefer to manage your portfolio with technical analysis and active risk management. This allows us to see the warning signs and take action if necessary, and also see the positive things that we've seen in the last month and take action to redeploy your capital. No system of money management is perfect, but we feel that our approach helps us mitigate those losses and navigate this volatile time that we see in these market cycles and stuff. Mm-hmm. So in the current bear market we're in, we still have not returned to the peak. I'm hopeful that one day in the next several months we'll be able to say we've returned, and we can fill in that blank there.
That would be great
for that, but that's okay. And we just know that these things take time to work themselves out.
Mm-hmm. So this is the big question that everyone wants to know. What's the solution here? And I said this earlier, but we don't like the phrase, "this time is different."
Oops, sorry. Oh. I accidentally clicked the button.
That's okay.
Wasn't supposed to.
We don't like that phrase, that "this time is different." It's often used to justify why you should sit on the sidelines and ignore the market and just be scared and wait years and years and not participate. So we don't believe in that philosophy.
Yeah, we still believe, hey, the future in the U.S. economy is relatively bright. There's going to be some bumps.
That's right.
Along the way, but we're seeing positive signs.
We really encourage our listeners to avoid making panic decisions or making any decision based on the headlines, because we can't trust them right now. It feels so natural, Mark, for us to make those irrational decisions based on our emotions rather than the data. And so that is a solution that we're encouraging right now, is to make informed, factual decisions and not emotional ones.
That's right. Because one of the worst, I've said it before, that people will get scared, they get out of the market, and they do nothing for months on maybe years on end. I know we've seen people in the past that got out of the market in 2009, right at the bottom, and then they did not want to get back in until it had recovered, which was 2015. And they missed out on the S&P 500. They missed out on 400% change between that time in the market. And it's just often, the fear of missing out motivates people. We don't use emotion here at Clear Vista. We try to use the data to tell us the picture. The data changes all the time, changes every day. It's probably changed in the time that we've been started this webinar.
Probably.
And we'll wrap it up here in just a minute. But if you don't have an advisor and you want someone to check with, or just get a checkup on your current portfolio, hey, we're here to help, and you can contact us. You can send us an email at info@clearvistafinancial.com. But we still believe that, it's still a little bit cautious and a little bit bearish. We're still in a bear market, right?
Yeah, the first step here is just check your statements. Even if it's your 401k or an account you haven't looked at in a while, don't be scared of it. Look at it, analyze it, and talk to a professional and educate yourself. It's the same thing that we've been doing for a long time.
Yeah, just talk to somebody. That'll help you a lot with that. And Jesse, I'm going to see if we can take any questions. I don't see you on the board right now, but we appreciate you participating in today's session.
Our text line is always available, 254 254-282-0495. We will try to answer that as quickly as possible. If you have a quick 30-second question or you have a more detailed one, we can have a discussion about it.
Okay. Well, folks, we're coming up on the end of our time today. I don't know what time it is. I don't have my glasses on, but we appreciate you joining our Clear Vista for Financial Perspectives. This monthly webinar will be back in January. I think that's, what is that, January 3rd, maybe?
I think so.
So hopefully you'll have a wonderful holiday season and a Merry Christmas, and hopefully the beginning of a great new year in 2024. Thanks for joining us. Have a great day.